All right, so here's a fun one. What if I told you there's a 65-year-old trucking company based in rural Arkansas that essentially invented the modern freight system? And they just dropped Q1 2026 earnings that beat on both the top and bottom line.
JB Hunt Transport Services, ticker JBHT. They're not just a trucking company. They basically pioneered intermodal freight in North America, and they've quietly become one of the most important logistics players on the continent.
We're talking about a company running over 100,000 containers across the country's rail network, and they just posted $3 billion in quarterly revenue. Let's dig into everything you need to know about JB Hunt. So, JB Hunt was founded back in 1961 by Johnny Bryan Hunt and his wife, Jonelle. The story goes that JB started out hauling rice hulls in Arkansas, literal agricultural waste, and turned that into one of the biggest transportation empires in North America.
The company operates through 5 distinct segments, and it's important to understand how each one works because they're fundamentally different businesses under one roof. The biggest is intermodal, which they call JBI. That's where containers move by truck to a rail yard, travel long distances by train, and then get picked up by truck for final delivery.
And the intermodal piece is massive. They've got over 104,000 pieces of trailing equipment and nearly 86,000 chassis units. But the real secret sauce is their partnership with BNSF Railway. That relationship goes back decades and gives them access to rail capacity that competitors simply can't replicate.
Then there's Dedicated Contract Services, or DCS, which is their second largest segment. Think of it as an outsourced private fleet. They design and operate customized trucking solutions for specific customers with dedicated drivers and equipment. Those contracts run 3 to 5 years with built-in cost escalators, so it's very predictable revenue.
They also run Integrated Capacity Solutions, which is their brokerage arm, final mile services for home deliveries of big and bulky items, and a traditional truckload segment. Headquarters is still in Lowell, Arkansas, with about 33,000 employees.
What makes JB Hunt unique in this industry is their technology investment. Their 360 platform is essentially a digital marketplace that matches shippers with capacity using real-time data and dynamic pricing. Most of their competitors are still running on phone calls and spreadsheets.
The company's being led by Shelley Simpson, who took over as CEO in January 2024. She's a true JB Hunt lifer, joined the company back in 1994, and worked her way through operations, sales, and technology before serving as Chief Commercial Officer and President.
Simpson is widely credited with driving the company's digital transformation, particularly the development of the 360 marketplace platform. Analysts generally view her as a steady, execution-focused leader who understands the business inside and out. She navigated the freight downturn without cutting the technology investments that should pay off when volumes recover.
She's got a reputation for being very data-driven and customer-focused, which is exactly what you want in a logistics company trying to stay ahead of the technology curve.
Let's get into the financials, and there's actually quite a bit to unpack here. JBHT is trading at $224.17, putting the market cap at about $21.3 billion.
And the valuation picture is interesting here because the stock is sitting at about 34 times trailing earnings, which is pretty rich for a transportation company.
Right. The trailing PE of 34.3 is definitely above the historical average for this sector. But when you look at forward estimates, the picture gets more reasonable. Analysts have them at about $8.80 in EPS for 2027, which puts the forward PE closer to 25 times. The price-to-sales ratio is 1.8, and the enterprise value to EBITDA is 14.4 times.
So the street is clearly pricing in a recovery here.
Exactly. Now on the income side, trailing 12-month revenue comes in at just over $12.1 billion, with the most recent Q1 2026 quarter doing $3.06 billion. That's a 4.6% increase compared to Q1 of last year, which is meaningful because this company saw mostly flat to declining revenue during the freight recession.
What about profitability? Are they actually making money through this downturn?
They are, though margins have compressed. Gross margins are running at about 28.6% on a trailing basis, operating margins at 7.4%, and net margins at 5.1%. The operating margin in particular has come down from the double-digit levels they hit during the freight boom in 2022. EPS for the trailing 12 months is about $6.53.
And cash flow, that's always important for these asset-heavy businesses.
Cash flow is actually one of the bright spots. Operating cash flow over the trailing 4 quarters was about $1.7 billion, with free cash flow of $947 million after capital expenditures of about $730 million. They're clearly generating enough cash to fund the business, return capital, and service their debt.
What's the balance sheet look like?
The balance sheet is manageable, but not pristine. They've got $17 million in cash. Yes, that's very low, but that's typical for JB Hunt because they use revolving credit facilities aggressively. Total debt is $1.9 billion against $3.6 billion in shareholders' equity, giving a debt-to-equity ratio of 0.53. The current ratio is 0.83, which looks tight but is normal for their business model. Return on equity is nearly 17%, and return on invested capital is 9.3%.
So they're earning well above their cost of capital.
They are. Overall, JB Hunt's financial health is solid. The company is generating strong cash flows and maintaining reasonable leverage while investing through the cycle, though margin recovery remains the key variable for the stock.
So what are the analysts saying about this stock right now?
It's a mixed picture. Out of recent analyst actions, we're seeing roughly a balanced split. There are meaningful buy ratings from firms like Benchmark, BofA Securities, JP Morgan, Wells Fargo, Baird, and Evercore ISI Group. But there's also a substantial hold contingent from Stifel, Truist Securities, Barclays, Goldman Sachs, UBS, and Bernstein.
Any big moves recently?
2 that stand out. Susquehanna upgraded JBHT to positive back in January, calling it a freight cycle inflection play. But going the other direction, Citigroup downgraded to neutral around the same time, flagging concerns about intermodal pricing power. Deutsche Bank also upgraded to buy in December 2025, betting on margin recovery.
And on the most recent earnings, Q1 2026 just dropped today, right?
Yes, filed today, April 15th. Revenue came in at $3.06 billion versus estimates of about $2.96 billion, so a revenue beat. EPS hit $1.49 against the street's expectation of $1.45, so it was a double beat, though not by wide margins.
Management commentary on guidance.
They maintained full-year guidance, which was what the market expected. Shelley Simpson pointed to early signs of freight market recovery in intermodal volumes and noted stable DCS contract renewals. She acknowledged tariff-related uncertainty, but said JB Hunt has limited direct exposure to cross-border freight flows.
All right, let's lay out both sides. I'll take the bull case. The biggest thesis here is freight cycle inflection. The trucking industry has been in a prolonged downturn since late 2022, and the data is starting to suggest we're at or near the bottom. Spot rates are stabilizing, intermodal volumes are ticking up, and capacity is leaving the market as smaller carriers can't survive.
And the bear case starts with the question, what if we're not actually at the bottom? Intermodal volumes could remain subdued if industrial production stays weak, and the tariff environment adds a layer of uncertainty that could suppress shipper confidence and delay inventory restocking.
Fair, but on the bull side, even if recovery is gradual, JB Hunt is uniquely positioned. Their DCS contracts are rolling off and renewing at higher rates. Those 3 to 5 year contracts locked in during the downturn are being replaced with better economics. The 360 technology platform is gaining market share and creating stickier customer relationships. And there's a long-term structural shift happening where shippers are converting from over-the-road to intermodal for both cost and sustainability reasons.
On the bear side, the valuation gives me pause. At 34 times trailing earnings, you're paying a premium price for a recovery that hasn't fully materialized yet. The ICS brokerage segment has been unprofitable during the downturn, and it's unclear when that turns around. Driver cost inflation remains a persistent headwind, and there's always the risk that BNSF rail service quality deteriorates, which would directly impact JB Hunt's core intermodal value proposition.
The bulls would counter that the aggressive share buyback program, over $900 million in repurchases last year alone, shows management confidence and provides EPS support regardless of the revenue trajectory.
That's true, and the buyback has been meaningful. But it's worth noting they're funding some of that with debt while keeping minimal cash on hand. It works fine when business is generating cash, but it reduces flexibility if conditions deteriorate further.
Let's see how JB Hunt stacks up against the competition. The three most comparable names are C.H. Robinson, ticker CHRW, XPO, and Knight Swift, ticker KNX.
C.H. Robinson is interesting because they operate a completely different model. They're an asset-light broker, meaning they don't own trucks or containers. Their PE is around 32 times, with a much lower price-to-sales ratio of 0.9. Lower margins, but significantly less capital intensity than JB Hunt.
XPO is the pure-play LTL carrier after their spin-offs. They're trading at about 28 times earnings with a price-to-sales of 1.2. The narrative there is strong pricing power in less than truckload, which is a structurally better market than full truckload.
And Knight Swift is the largest truckload carrier by fleet size, trading at just 22 times earnings with a price-to-sales under 1. They're more exposed to the spot market cycle, which means more downside in downturns, but potentially more upside in recoveries. JB Hunt's premium multiple reflects its intermodal moat and technology platform. The question is whether that premium is justified at current levels.
What's the options market telling us?
The put-call ratio is sitting at 0.72, which indicates a modestly bullish skew, more call buying than put buying. Implied volatility is at the 45th percentile, so not particularly elevated, suggesting the market expects moderate rather than extreme moves from here.
Any notable positioning?
The largest open interest clusters are at the 230 strike for calls and 200 for puts, both in the May expiration. That implies traders see a near-term trading range of roughly 200 to 230, but there's also elevated call volume at the 250 strike for July, which suggests some traders are positioning for a meaningful freight recovery rally in the second half of the year. As always, options activity reflects sentiment, not certainty.
On the insider front, what have executives been doing with their own shares?
Insider selling has been moderately elevated over the past 12 months, with about 8 sales versus 2 purchases. CEO Shelley Simpson and CFO John Kulo have both sold shares, though these appear to be planned dispositions under 10b5-1 plans rather than discretionary sales. The 2 insider buys came from board members in Q4 2025, which was notable, given the stock had just rallied significantly off its 52-week low of $122.
So planned selling, but a couple of opportunistic buys at the board level. That's not a red flag, but worth tracking.
Let's run through the key risks quickly. First, the freight recession could persist longer than expected. If industrial production remains weak, intermodal volumes won't recover regardless of capacity exits. Second, tariff uncertainty is a wild card. Any disruption to supply chains could impact shipper behavior in unpredictable ways.
And on the operational side?
Rail service quality from BNSF is always a risk. JB Hunt's entire intermodal model depends on reliable rail transit times. Driver cost inflation continues to pressure margins across DCS and JBT, and the ICS brokerage segment has been a drag. If that segment can't return to profitability, it's a meaningful headwind to consolidated margins.
Key metrics to watch going forward.
Intermodal volume growth, DCS contract renewal rates, ICS segment profitability, and operating ratio trends. Those 4 data points will tell you whether the recovery thesis is playing out or not.
So let's bring it all together. JB Hunt is a best-in-class logistics company with a genuine competitive moat in intermodal freight and a technology platform that's ahead of the industry. They just beat Q1 earnings, the balance sheet is manageable, and cash flow generation is strong.
The question is really about timing and price. At 34 times trailing earnings, the stock is pricing in a recovery that's still in its early stages. If the freight cycle turns decisively, JBHT could see meaningful earnings expansion and the multiple could hold or even expand. But if recovery stalls, you're paying a premium for a cyclical business in a tough environment. The metric to watch is intermodal volume growth. When that inflects convincingly higher, the earnings leverage will follow.
That's the one number that tells you whether the bull thesis is working or not. And I love this quote to close us out. Lily Tomlin once said, "The road to success is always under construction." And for JB Hunt, that's about as literal as it gets.
That's pretty on the nose.
That's going to do it for this Charged Alpha deep dive into JB Hunt Transport Services. If you found this useful, make sure you're subscribed so you never miss an episode. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street